So is the Sprott Physical Silver Trust, ticker symbol PSLV, is it like the ultimate undervalued play for 2026? Or is it just, a perfectly designed value trap that's going to chew up your portfolio?
That really is the defining question for commodity investors right now.
Yeah, and you send us the data. We've got the vault ledgers. And today, we are really digging into it. We're doing a deep dive, looking under the hood of a trust with $17.29 billion in assets under management.
Massive scale.
Right, and we're pulling from the latest financial statements, technical charts, analyst ratings, and honestly, some really revealing institutional order flow data. All of this accurate as of April 16th, 2026.
Exactly. And our mission here is really just to separate the signal from the noise.
Yeah. And just a quick caveat up front, so we are all totally on the same page. This is strictly an intellectual exploration of the data. This is absolutely not financial advice.
Right, definitely not. But let's set the scene with the reality on the ground today. Because currently, PSLV sits at $25.55, following a very slight intraday decline of negative 0.54%.
Which, looking at a daily blip like that is practically meaningless without the broader context.
Oh, entirely meaningless. And the context here is bordering on historic, honestly.
Yeah, because I was looking at the 52-week range in the data you shared, and it is completely untethered, like a low of $10.73 and a high of $38.13.
It's wild.
For a physical commodity, that kind of movement is staggering. To see an asset almost quadruple from its bottom and then just pull back so aggressively, it immediately begs the question of what is actually holding this thing up.
Exactly. And before we can even, analyze where the price is headed next, we really have to look at the structural foundation. Because PSLV it's not a traditional company.
Right. They aren't manufacturing anything.
No, not at all. It's not a mining operation dealing with labor strikes or the cost of diesel fuel to pull ore out of the ground. It is a closed-end trust.
Okay, so what did that actually mean for the person buying in?
Well, its singular function is to provide you with exposure to fully allocated, unencumbered physical silver bullion. When you buy a unit, you are quite literally buying a fractional claim on real silver bars.
Just sitting in a heavily guarded, insured vault somewhere.
Exactly. Stacks of silver in a vault.
And naturally, they charge a toll for guarding that vault, right?
Mm-hmm.
But the management expense ratio, the MER, is surprisingly lean. It's at 0.56%.
Which is incredibly low for what it is.
Yeah, in the world of physical commodity funds, where you have to pay for armored transport, auditors, 2147 security, that is highly manageable.
It really is. You are basically paying for the administrative machinery of the trust without taking on the operational risks of, say, a mining company.
Okay, well, let's unpack this a bit, because I am staring at the financials for the trailing 12 months, and my brain is completely short-circuiting on the income statement here.
Yeah, the numbers look a bit crazy at first glance.
Crazy is an understatement. We've got revenue sitting at a massive $8.52 billion. Net income for fiscal 2024 is $821.2 million. Earnings per share at $5.30.
Yeah.
And the net margin, I swear I had to read this 3 times, the net margin is 99.49%.
It's almost literally 100%.
Wait, how do you get a near 100% profit margin if you're actively bleeding cash? Because I see here $27.69 million in negative operating cash flow just to pay those vault guards and auditors. How does that work?
What's fascinating here is it's really the accounting illusion of commodity trusts. You are looking at it like a traditional tech company or a manufacturer, right?
Revenue basically equals cash in the bank.
Exactly.
Yeah.
But PSLV doesn't sell software. They hold metal. That 99.49% net margin is largely driven by unrealized gains on the physical silver sitting in the vault.
Oh, I see.
Yeah. So as the price of silver skyrockets, the value of their holdings just explodes on the ledger. That counts as income, but it requires literally zero operational cash to achieve. Okay. So it's pure paper profit. But day to day, they still have to keep the lights on and pay the insurance premiums, right?
Precisely. That negative $27.69 million in operating cash flow, that is the actual day-to-day cost of running the trust. But if you look at the entire cash flow statement, you can see how they plug that hole.
Oh, so
they have massive financing inflows, specifically $356.65 million coming from capital stock issuance.
So they are printing new shares and selling them to the market.
Yes, they constantly raise capital by issuing new units, and the crucial part is what they actually do with that capital.
They don't use it to pay executive bonuses, I'm guessing.
No. The prospectus strictly mandates they go out and buy more physical silver to stack in the vault.
Yeah.
So the negative operating cash flow is just, the administrative friction of doing that massive volume of business.
Okay.
The balance sheet remains rock solid because the physical assets inside the vault just keep growing exponentially. Okay, so the vault is physically secure. The accounting quirks actually make sense now, and they are successfully accumulating capital. But that doesn't explain why the stock price is acting like a roller coaster.
No, it doesn't.
So what is the actual trading floor doing with this asset today? Let's get into the technicals.
Yeah, the technical picture right now is fascinating because we are seeing this massive divergence between short-term noise and long-term momentum.
Meaning what?
Well, in the very short term, the market is showing consolidation. It is simply taking a breath, right? But when you zoom out and look at the long-term indicators, the signal is strongly bullish.
Yeah, I'm looking at the momentum indicators here.
Yeah.
With a 14-day RSI sitting at 63.17,
Yeah.
we've got plenty of upward momentum left before we hit, true overbought territory.
Exactly. It's a very healthy climb.
But the NCD is sitting at 0.338. So the bullish crossover is completely intact, but what does that actually look like on the ground? Are we talking a rocket ship here or just a steady grind?
It's a steady, methodical grind. At 0.338, you aren't seeing that parabolic blow-off-top momentum that usually precedes, a massive, painful crash.
Okay.
Yeah, it is characteristic of steady accumulation. The upward pressure is there, but the market is digesting the gains rather than just hyperventilating.
Okay, and I'm looking at the moving averages here, and there is a massive concrete floor right below us. The 5-day simple moving average is at $25.67.
Right, so today's price of $25.55 is testing that immediate support.
But the real story is the major trend support, right?
Yeah.
The 50-day SMA is sitting at $24.60, and the 200-day is right above it at $24.73.
Yes.
Is that just retail investors holding the line, or is something, bigger happening at that $24.70 mark?
This is where it gets really interesting and where the order flow data becomes absolutely critical. We are detecting significant institutional footprints between $24.70 and $25.
Meaning what exactly? Are these just automated buy walls?
They act as immense liquidity magnets. When the price dips into that $24.70 to $25 range, we see these violent spikes in volume that, they simply do not come from retail traders buying 10 shares on their phones.
Right, it's the big players.
These are large institutional buyers, whales. They have historically accumulated massive positions right at these levels, which provides a profound cushion for the stock price.
They're just waiting for it to drop.
They are essentially telegraphing to the market, if you drop silver to $24.70, we will absorb every single share you are willing to sell.
Wow. If the whales are defending that line so aggressively, they must see this asset as fundamentally mispriced.
Absolutely.
Which kind of brings us to the core debate we keep seeing across all our sources today, PSLV's valuation. Is it genuinely undervalued, or are we just looking at a mirage?
This really is the crux of the matter, because PSLV is currently trading at a negative 5.18% discount to its net asset value, its NAV.
Okay, and the actual net asset value is $27.20?
Right. That means if you take all the physical silver locked in their vaults and divide it by the number of outstanding shares, each share represents exactly $27.20 worth of metal.
But the open market price is $25.55. So I am effectively buying a dollar's worth of actual physical silver for about 95 cents.
That's the math.
On paper, with a PE ratio over the trailing 12 months of just 1.69x, this looks like the easiest trade of the decade. Analysts are slapping strong buy ratings all over it, especially looking at that massive 132.67% one-year return.
It looks incredible on paper.
But, and here's my issue with it, buying PSLV right now feels like buying a $100 bill locked in a glass box and you're paying $95 for it.
Yeah.
It's a great deal, but only if someone eventually gives you the hammer to break the glass. If you can't access the actual value, what's the point?
That is the perfect analogy, and it goes straight to the heart of why this can be a brutal value trap, because a discount to NAV is only profitable if the gap eventually closes.
Right, because if it doesn't close, you're just holding dead money.
Exactly. Because this is a closed-end fund, it can technically trade at a discount into perpetuity.
Wow, really?
Yeah, unless the trust actively liquidates the silver and hands you the cash, which entirely defeats the purpose of the trust, or unless market sentiment violently shifts to drive the premium up, you could be holding an asset worth $27 that you can only ever sell to the next guy for $25.
So what actually breaks the glass then? Because without that hammer, it seems like a lot of retail money gets absolutely chewed up in this market.
Right.
We have to look at the downside risks here. What is the bear case that is keeping that discount wide open?
The bear case rests on two very unforgiving pillars. First is the zero yield. Silver does not produce cash flow.
It doesn't pay a quarterly dividend.
No, not at all. When you hold PSLV, you are entirely 100% reliant on price appreciation. If the silver price goes sideways for 5 years, you make absolutely nothing, and the hidden tax of inflation slowly eats away at your real purchasing power.
Yikes. And the second pillar?
The volatility. Silver has a notoriously high beta. Even if the macro trend is pointing up, the short-term pullbacks can just rip your face off.
It is basically designed to shake the market. And this is exactly where retail traders get slaughtered, isn't it? Because right now, the sentiment indicators are flashing greed and bullish.
Oh, heavily. It's being driven by pervasive inflation fears. People watch their grocery bills climb, they panic, and they blindly flock to hard assets.
But wait, if we are in a greed phase and inflation is a genuine threat, shouldn't a physical silver trust be a relatively safe harbor?
You would think so. But the silver market is notoriously driven by paper trading and these violent sentiment swings. During these hype cycles, it becomes a roach motel for retail money.
A roach motel.
Yeah, they check into the premium when headlines are screaming fear of missing out kicks in, and they buy the absolute top.
Oh, I see.
But because there's no yield to pay them while they wait, the moment a violent short-term drop happens, they panic. They can't afford to hold through the dips, so they capitulate and sell at a massive loss.
Often right into the waiting hands of those institutional whales, stationed in the lobby at the $24.17 discount zones.
Exactly.
They get shaken out by the volatility and just hand their cheap silver over to the institutions. It's brutal.
It happens every cycle.
But why are those institutions waiting in the lobby to begin with? Like, what do the whales see on the horizon that gives them the conviction to keep buying the dips? Let's shift to the bull case and the long-term structural outlook here, because our sources point to some massive macroeconomic shifts happening in 2026.
To understand the bull case, you really have to separate the short term from the long term.
Okay, let's do that.
In the short term, traders are just looking for a breakout above today's $26.11 resistance high to confirm the next leg up. But the medium to long term outlook, it is rooted in physical reality.
What kind of reality?
We are witnessing a historic collision. Years of structural deficits in global silver mining supply are violently meeting a wall of unstoppable industrial demand.
And this is not about, like, jewelry or silverware anymore.
No, not at all. It is entirely driven by the green energy transition, specifically the EV market and the solar sector.
I want to dig into the physics of that for a second, because silver isn't just shiny, right? It is literally the most electrically and thermally conductive metal on the periodic table.
It is the absolute best conductor we have.
Right. You cannot build a highly efficient solar panel without a specific, highly refined silver paste for the photovoltaic cells.
You literally can't.
And you cannot wire the incredibly complex battery management systems in a modern electric vehicle without it either. Like, copper simply degrades too fast and creates too much heat for those highly sensitive micro-level connections.
That is the immovable reality. The mining supply simply cannot scale fast enough to meet the manufacturing quotas required for global solar and EV rollout.
So the physical deficit is just widening every single month.
Exactly. Which brings us to a massive catalyst that triggered in January of this year, 2026.
What happened in January?
Sprott fundamentally expanded its at-the-market, or ATM, equity program. They are now authorized to issue up to $2 billion in new units.
Wait, $2 billion just to meet investor demand?
Right. And think about the mechanics of that. When Sprott issues those units, the prospectus mandates they use the cash to buy physical bullion.
Oh, wow.
Yeah, so that ATM program is essentially a $2 billion vacuum cleaner hovering over the global silver supply. They are draining physical bars from a market that is already experiencing a severe structural shortage.
And there are specific benefits to using PSLV to play this shortage over, like, other paper silver trades or standard ETFs, right? The sources highlight some massive tax implications for U.S. investors.
Significant advantages, yes. First, you have the physical safety. Unlike some ETFs that rely on unallocated accounts or complex derivative swaps things that could fail in a liquidity crisis, PSLV units are redeemable for real physical silver bars.
Meaning if you hold enough units, you can legally demand delivery.
You can actually get the metal. And second is the tax efficiency. For U.S. investors, holding PSLV offers the potential for long-term capital gains rates of 15% to 20%.
Which is huge.
It is, because many other silver ETFs are classified as collectibles by the IRS, which subjects them to a punishing 28% tax rate. That is a massive difference in your net return at the end of the day.
So to kind of synthesize everything we've torn through today, we are looking at a profound tension in the market right now.
A total tug of war.
Right. On one hand, you are holding a zero-yield asset that is terrifyingly volatile. It is entirely capable of dropping 30% in a month just to shake out weak hands. And right now, it might just be a value trap stuck at a 5% discount to its actual metal value.
That's the bear case in a nutshell.
But then on the other hand, you are betting on the completely unstoppable forces of global industrial demand, a severe supply deficit, unique tax advantages, and heavily defended institutional support levels acting as a concrete floor.
Yeah. If we connect this to the bigger picture, holding PSLV right now is essentially a leveraged bet on reality.
A bet on reality. I like that.
You are betting that the tangible, undeniable industrial requirements of millions of EVs and billions of solar panels will eventually overpower the short-term, sentiment-driven, paper-trading volatility of the broader silver market.
And the institutions absolutely believe the physical reality will win out over the paper noise.
Which is exactly why they relentlessly buy the dips.
It is the ultimate showdown between the paper market and the physical market.
Yeah.
But before we wrap up today, let me leave you with something to really chew on.
Let's hear it.
We talked about how the unique feature of PSLV is that the units are fully redeemable for actual physical silver bars.
Right.
Well, with this structural supply deficit looming, and industrial demand from the EV and solar sectors skyrocketing to completely unprecedented levels, what happens to the broader, highly leveraged paper silver market if those large institutional investors, the whales currently sitting in the discount zones, suddenly decide to call the bluff? Like, what happens if they redeem their units en masse and demand physical delivery of the silver? Are there actually enough real silver bars sitting in the global vaults to satisfy all the paper claims floating around the market?
That is the multi-billion-dollar question that keeps commodities brokers awake at night.
And it is a question we will be tracking very closely. Thank you for joining us on the deep dive into PSLV. Keep questioning the charts, keep looking for those hidden institutional footprints, and keep digging deeper on your own. We'll see you next time.